Hello everyone, this is Dr. Mihir Shah once again with another video. In this video, we are going to solve October 2022 University question paper of TYBMS Sem 6 of Project Management. Okay, now the paper has already been solved, so I'll explain you all how to solve that particular paper. Okay, so let us start with the very first sum. The question which was given was that a company has to make a choice between two possible investment project A and B. The immediate capital outflow is going to be 80,000 each. Each will continue for 5 years and has a discount rate of 10%. The cash flow before debt and after tax is given. So this is profit before tax, but after debt. Okay. So they have given you this table. They're giving you the cash inflows, and they're asking us to find the NPV and profitability index. Okay, two things have been asked. So first we'll solve for company A or project A. So we have years, maybe write first 5 years. Cash inflow, we'll note down the cash inflow which are given. Now this is before, this is before depreciation, okay, and after tax. So whatever is given is the PAT. After cash inflow, we have to add the depreciation and we'll get the cash flow. Now depreciation will be very simple. It is 80,000, the value of asset divided by 5 years. So you got 16,000 each. So depreciation we will write 16,000 each. We add up cash inflow and depreciation and we get cash flow basically. Note down those cash flows. Okay, so 15 plus 16, 31, 22 plus 16, 35 plus 16, 25 plus 16 and 20 plus 16, we get the cash flow. After that we have to take a discounting factor. It is at 10%, so it will be 1 divided by 110%. So we get a discounting factor, so it will become 0.909, 0.826, 0.751, 0.683, 0.621. Okay, last step, cash flow multiplied by your PV factor or discounting factor, we will get a present value of cash inflow. Okay, so you multiply, you get the values, and the total of that value is a total PV, your total present value. Okay, once you get the total present value, now it's very simple. In order to find NPV, the formula is total PV minus initial outflow. So 1,48,227 minus 80,000, we will get your first answer, your first NPV. And for profitability index is the division. Okay, so it will be out inflow ka total divided by outflow. So 148,227 divided by 80,000 and you will get your profitability index. Now in the same way you have to do for project B also. So years cash inflow depreciation, you add depreciation, you get cash flow, you multiply with the PV factor, you get the present value, you get the total PV. Total PV minus the initial investment will give you your NPV, and again inflow minus divided by outflow, you will get your profitability index. Okay. Now similar sums have been already solved before, so this has already been solved. Okay, so I'm just explaining how to solve, so you all can practice and go through it. Okay. So this was the very first sum which was asked. Now we jump to the second sum. The second sum they told you calculate combined leverage, financial leverage, and operating leverage for the following firm. NSD and DSN, two firms are given, number of units are given, fixed cost is given, interest is given, selling price per unit is given, and variable cost per unit is given. Income statement where sale less variable gives you contribution, less fixed gives you EBIT, less interest will give you EBT. Okay, selling price per unit, variable per unit, you multiply with the number of units. Okay, we will get the total sale and total variable cost. You subtract, you get contribution. From that we minus our fixed cost which is directly given. We'll get earning before interest and tax, that is EBIT. From that we minus our interest and we get our EBT. Once you all have got that EBT ka value, now it's very simple. First we need to find the formulas of operating leverage. So degree of operating leverage or operating leverage is contribution upon EBIT. Take the value of contribution, take the value of EBIT divided and you get your answers. Same way for financial leverage, the formula is EBIT upon EBT. So take EBIT and EBT ka totals. Okay, divided and you will get the value of your your financial leverage. And lastly, combined leverage, that is nothing but the product of operating leverage and financial leverage. So you multiply them, you will get your combined leverage. Okay. Again, similar sum has been solved earlier. So this is just the format. You should understand it. Okay. So once you understand, you can easily substitute the values and get the answer. That was the second question in this. Okay, we jump to the third one. Now, third one, may they're giving you following is the balance sheet of Somo Limited. They're giving you the liabilities and they're giving you the assets, and they're asking you to calculate the book value of share. Basically, the value of share they're asking you to find. Now, according to with which method will you solve? Very simple. They've only given you assets and liability. We have to follow net asset method or intrinsic value method. Okay, so as per so the format is all the assets minus liabilities, that is outside liabilities. So on the asset we have goodwill, we have furniture, land, plant and machinery, stock, debtors, bank, no preliminary expense because fictitious, no P&L debit because the loss. So we noted down all the assets, got the total value of asset minus outside liability. Equity is internal, general reserve internal, so we have only creditors and bank overdraft. We will subtract that asset minus liability and we'll get the net asset available to the equity shareholder. That value divided by the number of shares. 1,60,000 of 100 each, 20 less, so 1,600 shares. So we got 1,600 shares. So 1,95,000 divided by 1,600, you will get your net asset value per share or book value of per share, which comes to 121.875. Okay, again similar sums have been solved. Very simple sum. You just have to note down the asset less the liability, get the assets available to the equity shareholder divided by the equity share. You will get the NAV per share. Okay. Now the last sum which was there in this paper was based on the case study. Acha, now for those who are having difficulty in case study, I have already uploaded the questions for short notes. So those who are having difficulties in the case study, okay, I would prefer for them, attempt the case study. Sorry, attempt the short notes because that will be easier. See, in the case study, if you miss out any amount, so there are chances that the whole thing can go wrong. In short notes you will never get it wrong. Okay, you cannot get zero for a short note. So rather than getting, those who are not able to get the case study, I would prefer, I would prefer that they should appear the short note, because in short note you can easily score. Okay, just need to learn the short notes ka list which I have given you all. Okay, that will be more than enough. Okay, now Measures Kia Limited proposes to set up a new plant at Thane for processing the industrial waste into marketable product. The product has a demand for 75,000 units. The variable cost is 15, fixed is 80,000. Product can be sold for 37. Raw material is 5. Capital employed is 25 lakhs. Company gets 20 lakh ka loan for 6 years, which is the life of the asset. Loan is payable in 6 equal installments along with interest at the end of each year. Rate of interest is 12%. Income tax is 30. Give income statement for the first 5 years. Debt and calculate debt service coverage ratio for the above 5 years, and amortization schedule for the repayment of loan. Okay? So we started the income statement. Now remember, in income statement, the format will be particulars 5 years. We start with sales. Now sales, how will you get? 37 per unit is sold and there are 75,000 units. Multiply, we get the value of sale for all the 5 years. Less cost of goods sold. Under that, we have anything which is related to variables. So we have raw material 5 rupees each, 5 into 75,000, and variable cost 15 into 75,000. You minus sale less COGS, will get a GP. From that, you minus your fixed expenses, which is given as 80,000. We get a profit before depreciation, interest, and tax. Now, in order to find depreciation, the capital investment was 25 lakhs. 25 lakhs divided by 6 years, it comes to 416667. Take it in all the columns, minus it, we'll get a profit before interest and tax. Now, profit is before interest and tax. Now, we need to calculate the value of interest. For that, we'll have to create the amortization table. Okay, so we'll stop this income statement till this part and jump to now the amortization schedule. So amortization mein we have 6 years. The loan amount was 20 lakhs, so we start with 20 lakhs. Interest is at 12%, to 20 into 12% is 2 lakh 40. Now this 20 lakh has to be paid in 6 equal installment. So 20 lakh divided by 6 is 333333. That is 3,33,333. You add interest and principal amount, you will get your loan amount, and you minus your opening with your loan. You minus your opening with your installment value, that is principal installment. Okay, and you will be able to get your closing value. So again, so we got this 570, the 20 lakh minus 3,33,333, we got 16 lakh thingy. So 16 stuff comes here. Again, on that take 12%. the installment amounts are same, add up, you get the loan installment. Again, you have to keep following that order, and we get an interest. So the first interest was 2 lakh 40, then 2 lakh, 1 lakh 60, 1 lakh 20, 80,000 and 40, but we only need up to 5 years. So 240, 2 lakh, 1 lakh 60, 1 lakh 20 and 80,000 will be taken from this table, and we'll post it in our income statement. So our income statement will have 2 lakh 40, 2 lakh, 1 lakh 60, 1 lakh 20 and 80,000. Subtract, we get profit before tax. Tax is 30%, remove 30% of PBT, we got the tax value, minus, and we'll get a profit after tax. So this was our income statement before. Okay, then we even made the amortization schedule, and now we need to get the debt service coverage ratio. Now for debt coverage survey, okay, I kept the income statement amortization schedule. The debt service coverage ratio ka formula is PBDIT, that is this line. So that is 11 lakh 95,000 each, divided by principal plus installment amount. That's nothing but the loan amount. So PBDIT divided by loan amount, okay, loan installment, okay, will give you your debt service coverage ratio. So for every one, okay, we take 11 lakh 95,000 with the first year 57, then 5333, 49333, 45333, and so on, and you will get the value of debt service coverage ratio. Okay, so with that, we were able to solve the complete paper of October 2022. I hope everyone have understood that. With that, we will be ending this video here. Thank you.